Your business is making more sales every month. You're hiring new people. You work from early morning until late at night. And at the end of the month, you check your bank account and there's silence. Empty. Zero. You're not building a business. You're building a loud, expensive machine that burns your own time and money. Voluntary slavery, where every month you feed the landlord, the bank, and the tax office, and leave yourself only the crumbs from the burger. Identification. Look at the typical entrepreneur. Let's say he sells burgers. He opens his banking app, sees $100,000, and is already mentally choosing the color of the leather interior for his new car. Eyes shining, heart singing. Then the end of the month arrives. He pays rent, salaries, taxes, suppliers, advertising, and the account shows zero. Or worse, a fat red minus. Why does this happen almost everywhere? Because this person has made the cardinal mistake most business owners make. He genuinely believes that if he just sells a lot of product and does it fast, net profit will magically appear by itself. Market magic, the miracle of scale. The burger entrepreneur pours all his energy into the business, works 16-hour days, rents a spot in the city center, makes other people work for him, yet he completely misses the most fundamental principle of economics. He has no idea how much real, fully cleaned money one single sold item actually brings him. One burger. He's playing this complex financial game blindfolded, guided only by the sound of dollars hitting the account, not realizing that most of those dollars don't belong to him at all. Today, I'm removing the blindfold. We're going to break the business down to atoms. By the end of this video, you'll understand why blind scaling is the fastest route to bankruptcy, why big sales hide fatal mistakes, and how one unaccounted paper napkin can drag the entire company to the bottom. Economic amnesty. So, where exactly is the system broken? Why does this keep happening? Millions of years of evolution taught Homo sapiens one thing in the wild. Gather resources into a big pile. You survive. See lots of food? Rejoice. See an empty cave? Panic. That's why, when you see a big revenue number on your phone screen, your brain dumps dopamine, the pleasure chemical, and literally blinds you. You stop noticing the tiny holes in your budget through which real money leaks every single day. On top of that, the economic system itself, tax authorities, important men in suits, banks, deliberately created an environment so complex that an ordinary person simply gets lost in the reports. Invisible fees, hidden charges. You don't even notice how every transaction carries an extra cut. People are trying to manage a complicated mathematical machine using only basic instincts. But ignorance of the system's rules doesn't protect you from losing money. We're going to fix that. The turnover illusion. Let's start with the biggest illusion. People love bragging about turnover. At every meeting, my turnover is $1 million a year. Turnover is simply the total amount of money that passed through your hands during a period. All the money you received from customers before you paid anyone anything. From the outside, it sounds like, I moved 1 million rocks from one place to another, wrecked my back, but at least everyone saw how busy I was. Here's the trick. Turnover is not your money. It's the suppliers, employees, and government's money that you held for a few minutes like a transit passenger in an airport. Now the key question. What's left after you've paid everyone? That's net profit, the real money you can actually spend on yourself without destroying the business. Turnover is for vanity. Net profit is for living. So what? Stop measuring success by turnover. It's like bragging that 100 liters of water passed through your hands while you have only 3 drops left in your glass. Let's keep going. The scale trap. This is where most people fall into the abyss. If one sale loses you $1, 1,000,000 sales will lose you $1,000,000. Scale doesn't fix bad math. It makes the disaster inevitable. Most think, right now I'm working at a loss to capture the market. When I get 10 times more customers, I'll get rich. Classic trap. If your bucket is leaking, the harder the water pours in, the faster you flood your own house. Growth without profit is like a tumor. You hire more people. Complexity increases. More mistakes. The budget hole turns into a black hole. And then you wonder where the money went. So what? You can only scale what is already profitable at the unit level. One burger, one deal, one customer. Now let's look at exactly where you're losing money. Anatomy of a burger. Let's open up our main product, the burger. It doesn't appear out of thin air. Every part has a strict cost. In business, this is called direct cost of goods sold per unit. The rule is simple. If you don't sell the item, you don't incur these costs. That's the most important relationship. One $10 burger breakdown. Bun and patty, $2.50. Sauce, cheese, vegetables, $1. Packaging, napkin, bag, 50 cents. Electricity and gas for one cook, 20 cents. Card payment processing fee, 3%, 30 cents. Cook's wage for 5 minutes, $1.50. Total direct costs, $6. Sold for $10, spent $6 to make it. Difference equals $4. That's gross profit. What remains after direct production costs? Sounds decent, right? But hold on. Out of that $4, you still have to pay rent, internet, accountant, advertising. And here's where it gets really interesting. Many entrepreneurs forget about napkins, about card fees, about waste, about packaging. Yet it's precisely these cents that add up to astronomical losses. Tiny 10 to 20 cent leaks per unit turn into massive holes over a year. So what? These small things eat up to 30% of potential profit. Count everything, including the tape you use to seal boxes. Moving on. The cost of attention. So we have the burger. Now someone actually needs to know it exists. In today's world, you can't just stand on the street yelling that your burgers are the best. You pay tech companies to show your product on people's smartphone screens. That's called customer acquisition cost. How many dollars you have to give an ad platform so one living person will come to you and open their wallet. Example, spent $1,000 on ads, got 100 buyers. Cost per customer equals $10. Now watch the trap. If your burger sells for $8, you have catastrophic problems. You're literally paying $2 out of pocket for every person who deigns to eat at your place. That's not a business. That's an expensive way to feed strangers. If you don't know the exact cost to acquire one customer, you're burning your ad budget blind. Most do this. Pour thousands into advertising. Look at the total number of people who came and celebrate, without calculating how much each individual person actually cost. Result? Ad spend keeps rising. Profit keeps falling, and eventually you're working for Google and Facebook, paying them $100 to make 90. Then you hire more marketers, they raise the budget, and the company sinks even faster. Classic small business pattern that blindly trusts paid traffic without analytics. So what? Hoping for word of mouth is not a strategy. If acquisition cost exceeds revenue from the first purchase, you're playing a game you cannot win. Then how do giant companies survive when they lose money on the first sale? The answer lies in human psychology. Lifetime cycle. Smart corporations don't try to profit from you the first time. They think differently. The only way to survive is to make the customer come back. Customer lifetime value is the total amount of money one person will bring you over the entire time they remain your customer. Example, any movie streaming service. The company spends $50 on ads to acquire a new viewer. First month subscription equals $15, minus $35 in month 1. An ordinary person would panic here and kill the ads, but the corporation knows the numbers. Once you start watching their shows, you stay for an average of 3 years. Over 3 years, you pay them $540. Now the math works. $50 investment turned into $540 revenue. The golden rule that never fails. Lifetime value must be at least 3 times acquisition cost. You need to earn at least 3 times more from a person than you spent to acquire them. Less than that, you slowly die. Equal, you're doing charity for social networks. 3 times or more, you're building a real business. If a person comes, buys once, and never returns, you lost. You burned money acquiring them and earned nothing. But if your burger is so good that the person comes every Tuesday for a whole year, you've built a profit-generating machine. So what? Your goal is not to sell one item today. Your goal is to buy a person's loyalty so they bring you money for years. Great. Now let's tie it all together. Retention formula. If you focus only on one-off sales, within a year, competitors will squeeze you out. Most companies think sales team's job is to close the deal now and forget the customer. In reality, that creates an endless chase for new buyers because every month you start from zero. Ad costs rise, old customers leave, and you spend more and more energy just to stay in place. Remember fitness clubs. In January, they spend huge budgets on aggressive marketing, luring people with cheap annual memberships. They know perfectly well the client pays for the year, shows up exactly 5 times, then forgets the way. The club gets a year's money while barely spending any resources. Harsh, but mathematically flawless. Burger as a system. Let's look at your entire business through the burger. Bottom bun, foundation, your fixed costs. Rent, electricity, internet, software licenses, accountant fees. These expenses sit on you heavily every single month, whether you sell 1,000 items or none. They don't disappear. Patty, cost of goods, direct production costs. If you start saving on patty quality, customers notice, stop returning, lifetime value drops to 0. Sauce, marketing, customer acquisition cost. Marketing makes your product visible, but if the sauce costs more than everything else inside, if ads eat all the margin, the business loses meaning. Top bun, markup, the very money you started this for, your net profit. If the top bun is too thin, you'll starve. The business won't survive the smallest crisis. If you make it too thick by jacking prices for no reason, The customer simply can't swallow it and goes to competitors. The whole secret of this math is finding the perfect balance between patty cost, sauce expensiveness, and top bun thickness. Only when you achieve that balance at the single unit level can you start growing. If you start pouring money into ads before you nail the math of one burger, you simply accelerate your own collapse. Most leaders think, just flood more money into traffic and sales will cover the costs. In reality, a bad product or wrong price gets multiplied by the number of new customers. Result: mass returns, bad reviews, empty account. You pay for ads, people come, see a thin patty at a high price, leave forever and tell their friends not to go. Hiring trap. Okay, the math finally works. Now the entrepreneur thinks, I'll hire 10 more people. Revenue will skyrocket. Every new person in the system adds communication complexity and hidden costs. Imagine a kitchen. One cook calmly makes 50 burgers an hour. Logical, 2 cooks make 100. In reality, they make 80. Why? They bump into each other in the narrow passage, spend time coordinating, get distracted talking. Per unit efficiency drops as the company grows, unless you have strict automated rules. If you don't implement rigid SOPs when hiring, within 6 months, you lose control of expenses. Most just hire more people when the old ones can't cope, without changing the process itself. Result: payroll balloons, revenue stays flat. Hired 3 salespeople instead of 1. They start splitting clients, arguing, and end up selling less than one motivated person with good automation. So what? Growth for the sake of growth without process optimization is a guaranteed path to a bloated staff eating all the profit you manage to earn. The power of price. There's one more lever almost everyone ignores: price. Most entrepreneurs are terrified of raising it, thinking every customer will instantly run away. They keep old prices for years while rent, ingredients, and ad costs keep rising. Back to the burger. If your margin, what's left after one sale, is $1 on a $10 burger, you're walking on the edge of a cliff. But if you raise the price by just $1 to $11, your net profit instantly doubles. $2 instead of $1. Yes, maybe 5% of the most price-sensitive customers leave, but overall profit jumps dramatically. If you don't review prices at least once a year to match inflation, you're slowly subsidizing customers out of your own pocket. Most believe low price is the main competitive advantage. In reality, it deprives you of resources to improve product and service. A competitor who charges 20% more can hire a better marketer, buy better packaging, and take your quality-conscious customers. So what? You often work twice as hard purely because you're afraid to add 10% to the check. Customers who truly value your product usually won't even notice. How to fix the system tomorrow. Business is not success meditations or wealth visualization. It's dry, brutal mathematics. Turn away from the numbers and the market will destroy you. Here's a concrete algorithm. No philosophy. Step 1. Calculate true cost of goods. Open a spreadsheet and write down absolutely everything. Not just ingredient purchase. Include packaging, card fees, supplier transfer fees, tape for boxes, waste percentage. You'll be shocked how these pennies change the real picture. Step 2. Calculate true customer acquisition cost. Take all money spent last month on ads, marketers, designers. Divide strictly by the number of new buyers, not returning ones who came organically. That number shows how much it really costs to buy one person's attention in your niche. It may shock you. Step 3. Focus on retention, not acquisition. It's the cheapest way to grow revenue. Make service and products so good that people return without paid ads. Repeat sales are the cleanest money. You already paid to acquire that customer in the past. Step 4. Check price. Raise the price 5% on your best-selling item tomorrow. Watch the reaction. Most likely, nothing terrible will happen, but your economics will breathe easier. Final summary. So, my leather-clad friend, here are the rules. Revenue is not money. It's a financial flow that temporarily passes through your hands. One unprofitable customer is a local mistake. 1,000,000 unprofitable customers is bankruptcy. Count to the cent how much it costs to acquire one customer. Make sure that over the time they work with you, they bring at least 3 times what you spent on them. The devil hides in the tiny details of cost. Count napkins, electricity, fees. Scale only when the math works perfectly at the single unit level. Never pour money into a leaking bucket. Automate routine. Document clear rules for employees. Otherwise, their chaos will eat your margin. Be ruthless in calculations, but honest in product quality. That's the only working strategy. Your action for tomorrow. Take your top-selling item. Write down every single expense down to the last kopeck. Include allocated fixed costs, taxes, and ad spend. If what's left is less than 20% of the selling price, your business is balancing on the edge. Immediately review prices or cut costs. If you don't, you'll close as soon as your buffer runs out. So what? Now you know why there's no money in your account. The alien says thank you. Hit subscribe so the algorithms don't turn you into dust.